A phone screen lights up, a brokerage app opens, numbers flicker for a second, and then it hits. Portfolio value down 40%. Not a small dip. Not a bad week. Almost half of everything gone on paper. That moment feels heavy. The kind of heavy that makes the chest tighten a little. The instinct kicks in fast. Refresh the app? Maybe it's a glitch. Refresh again. Still down. Scroll through positions, red everywhere. Every stock, every fund. Everything bleeding at the same time. That's usually the exact moment when most people make the worst financial decision of their lives. Not because they're reckless, not because they're inexperienced, but because the situation feels urgent, dangerous, and completely out of control. And that's where things start to go wrong. Because here's the uncomfortable truth that doesn't get said enough. This exact moment has happened before. Many times. Across decades. Across completely different economies. Different crises. Different headlines. Same reaction. Markets don't just go up. They correct. They fall. Sometimes slowly. Sometimes violently. And anyone staying invested long enough will go through this more than once. Corrections of around 10%? Those show up frequently. Sometimes every year or so. Bigger drops, around 20%, tend to appear every few years. And the truly scary ones, the 30% or more crashes, those are rare, but real. And when they arrive, they don't send a polite warning. They hit fast. And they test everything. Every belief about long-term investing. Every assumption about risk tolerance. Every bit of confidence built during the good times. Because staying calm when everything is green is easy. Anyone can feel like a long-term investor when the portfolio is climbing week after week. But when things drop 1%, then 2%, then 3% every single day for weeks, something shifts internally. That's when doubt creeps in. That's when questions start forming. Not about strategy, but about survival. There are bills, responsibilities, a future that suddenly feels less certain, and that steady decline on the screen starts to feel like a real threat, not just numbers moving around. That's when people start abandoning the plan they believed in. There are real examples of this happening, even among disciplined investors. During major crashes, people who spent decades following steady, boring strategies suddenly snapped under pressure, sold everything, walked away, locked in losses at the worst possible moment. And here's what makes it worse. Many of them came back later, but by then, the market had already started recovering. And the fastest part of that recovery, the part where most gains happen, was already gone. That's the cycle. Buy when things feel safe. Sell when things feel dangerous. Repeat. And over time, it destroys returns. That's why the average investor often underperforms the very investments they're holding. Not because the investments fail, but because behavior fails. So the real question isn't whether markets will crash. That part is guaranteed. The real question is what actually gets done in that moment when everything is down 40%. Because that's where outcomes are decided. Not in the good times, not when things are smooth, but right there in the middle of the chaos. The first thing that needs to happen sounds simple, but it's one of the hardest moves to make. Stop checking the portfolio every single day. That might sound almost too basic, but constant checking during a downturn does something dangerous. It amplifies fear. Every red number feels like a fresh loss, even though nothing has actually changed unless something is sold. Watching the market tick down daily creates a false sense of urgency. It tricks the brain into thinking action is required immediately. But in reality, constant monitoring during a crash usually leads to emotional decisions, not rational ones. Stepping back doesn't mean ignoring reality. It means creating space between emotion and action. Because decisions made in panic rarely align with long-term goals. The next step is where things start to get more grounded. Revisit the original plan, not a new plan created in fear. The actual plan that existed before everything started dropping. Why was the portfolio built the way it was? What was the time horizon? 5 years, 10 years, 30 years? What was the purpose of the investments in the first place? If the time horizon is long, then a temporary drop, even a severe one, doesn't automatically change the outcome. It only changes how it feels in the moment. That's a key distinction, because markets have gone through extreme downturns before, and they've recovered. Not instantly, not smoothly, but consistently over time. There's data showing that even after severe crashes, staying invested leads to recovery and growth. For example, during one of the worst financial crises, a portfolio that dropped significantly eventually nearly doubled over the following years simply by not being touched. No timing, no clever moves, just patience. That doesn't mean doing nothing blindly. It means acting according to a plan instead of reacting to fear. And that leads to the next step, which often gets misunderstood: rebalancing. When markets drop unevenly, some parts of a portfolio fall more than others. Stocks might drop heavily, while bonds or cash hold steady. That shifts the balance of the portfolio away from its original design. Rebalancing brings it back. But here's the part that feels uncomfortable. Rebalancing during a crash often means buying more of what just dropped. That sounds counterintuitive. Everything in the brain says to avoid what's falling. But rebalancing isn't about predicting the future. It's about maintaining a structure that was designed for long-term growth. It's one of the ways disciplined investors quietly take advantage of downturns without trying to time the market. Because timing the exact bottom is nearly impossible. Even professionals struggle with it. And missing just a handful of the best recovery days can dramatically reduce long-term returns. There's data showing that missing only a few of the strongest market days over decades can cut final gains almost in half. And those strong days often happen right after the worst declines, which means being out of the market during that time can be extremely costly. That's why panic selling does more damage than the crash itself. Now there's another piece that comes into play, especially for those dealing with taxable accounts: tax loss harvesting. It sounds technical, but the concept is straightforward. When investments are down, selling them at a loss can offset gains elsewhere or reduce taxable income. Then, similar investments can be purchased to maintain exposure. This isn't about abandoning the market, it's about using the downturn strategically to improve long-term tax efficiency. It's one of the few ways to turn a paper loss into a tangible benefit without changing the overall investment strategy. But it needs to be done carefully, following rules around wash sales and replacement assets. So again, this isn't a panic move, it's a calculated one. And then there's something that doesn't get talked about enough during crashes: cash. Not in the sense of abandoning investments, but having a reserve. A financial cushion changes behavior dramatically during downturns. When there's cash available to cover expenses, there's less pressure to sell investments at the worst time. That's the difference between reacting out of necessity and acting out of strategy. During past crises, people with no savings were forced into decisions they didn't want to make: selling assets, taking losses, scrambling just to stay afloat. Meanwhile, those with a cushion had options. Some simply held steady. Others even took advantage of lower prices. That's where the idea of a war chest comes in. Not as a way to time the market perfectly, but as a way to stay in control when everything feels uncertain. Because control is the real advantage during a crash. Not predicting outcomes, not beating the market, just maintaining the ability to make clear decisions. And then there's the mindset shift that separates people who recover from those who don't. Understanding that downturns aren't just risks, they're also opportunities. That doesn't mean blindly buying everything that drops. It means recognizing that lower prices, in many cases, represent future potential. Historically, some of the best long-term returns have come from investments made during periods of fear and uncertainty, but taking advantage of that requires preparation. Preparation in the form of discipline, in the form of cash reserves, in the form of a clear plan that doesn't change every time headlines get dramatic. Because headlines will always get dramatic. Every crash feels unique while it's happening. Every time there's a reason why. This time is different. A new crisis, a new fear, a new narrative, but the pattern underneath stays the same. Markets fall, people panic, some sell, others hold. Eventually recovery begins, and those who stayed consistent come out ahead. Not because they predicted anything perfectly, but because they followed a process instead of emotions. And that process becomes even more important as the downturn continues, because the hardest phase isn't the initial drop, it's what comes after. The phase where prices keep falling, where confidence keeps eroding, where it feels like the decline will never end. That's where the real test begins, and that's exactly where most people fail, That second phase is where things get uncomfortable in a different way. Not the initial shock, but the slow grind downward. Days turn into weeks, weeks into months. The portfolio doesn't just drop once, it keeps drifting lower, sometimes in small steps, sometimes in sharp drops that come out of nowhere. This is where reality sets in. This is where headlines get louder, layoffs start getting mentioned more often, entire industries begin to feel unstable. Conversations shift from optimism to caution, and even people who were calm at the beginning start questioning everything. This is the phase where behavior matters more than ever, because the temptation here isn't just panic, it's exhaustion, the feeling of wanting out just to stop the discomfort, to stop seeing red numbers, to stop thinking about losses, and that's exactly why so many people exit right before things turn around. There's a pattern that shows up again and again. The market drops, people hold for a while, then eventually sell after the decline has already done most of its damage. And then, once things start to recover, they hesitate to get back in because it feels too uncertain. By the time confidence returns, prices are already much higher. That cycle repeats more often than most realize. And there's data behind this behavior. Missing even a small number of the best recovery days can drastically reduce long-term returns. Those strong days often show up during periods that still feel unstable. Not when everything looks safe again, which means the moment that feels the worst is often the moment when staying invested matters the most. This is also where another important shift happens. Instead of focusing on daily price movements, attention needs to move towards structure and consistency. And that's where real progress begins. If this perspective helped bring clarity to what's actually happening during a downturn, make sure to subscribe and stay connected, because the next time the market drops, the goal isn't to feel less fear. It's to know exactly what to do with it.